What's up, everyone on YouTube? So let's get at this again. I'm looking at another stock today and see if I should add it to my portfolio. But before I go into that, why am I buying dividend paying stocks? Well, it's to put into my bridge account, and this is the reason why I'm buying a dividend paying stock.
Never buy a stock that doesn't pay a dividend. That has been your advice through and through. Why are these stocks more attractive?
You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company. I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer, Yahoo? Never paid a dividend. It's never made money for anybody except all the CEOs that have gone through there and got whacked.
Now, at the end of the day, there's different strategies you can use to buy stocks. Warren Buffett really inspired me, and he changed my whole trading strategy.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now?
What are my requirements for my dividend paying stock? First, it has to be a dividend paying stock. 2, it has to be financially sound. And 3, it has to have good growth opportunity. And I'll go into more detail in this video about all this. Now, before all that, if you don't know what passive income is and what it is, here's a video.
Quickest way to not be on a beach in Mexico is to think that passive income exists. I think the reason so many scumbuckets are making so much money is because you're buying stupid courses over and over, thinking there's some magic formula for passive income. Passive income looks like this. You take money that you can afford to go to zero, and you put them into 2 places that have historically created passive income. Public markets, that you don't care if it goes up and down and you just wait to the end, or real estate, and you hope that your real estate area doesn't get crushed. Everything else almost doesn't exist.
So this is the company I'm looking at. It's Valero.
Valero proudly makes products that are essential to life. So we're always here for you. Not just today, but for generations to come. We've worked hard to become the largest independent refiner in the world, operating 15 refineries across the United States, Canada, and the United Kingdom, with exports to Latin America, Europe, Africa, and around the globe. But it's about more than numbers. Valero is with you, powering your life every day. And it's not just in the gasoline that fuels our cars and trucks. It's in the life-saving medical equipment that helps patients recover. It's in the hand sanitizer that keeps people safe, and the school supplies that help children learn. It's in the athletic gear that shapes our lives, and the jet fuel that moves the world above us. Everything from healthcare to public safety, to technological and scientific innovations, to personal adventures and beyond.
If you don't know what Valero is, here's a video about Valero, and this is the company I'm looking at right now. So it looks like they're in energy and renewable energy investors. So this is what Valero is. So let's look at the stock. I got enough information to know what they do, so let's look at the stock and see how they're doing. So according to the stock, year to date, it's up 27.88%. That's outstanding. That's pretty good year return. 1 year is 16.83. That's better. 3 years is 38.34. That's not bad. And max is 5 years is 206%. I think that's a pretty good stock. It's growing pretty steadily. So let's go into, does it pay a dividend? Yes, it pays a dividend. So let's go into what dividend percentage it has. Right now it pays 2.88% dividend yield. So annually it pays $4.52. Growth is 2 years, which is not that good. And dividend growth is 5.44%, which the growth of the dividend is not what I'm worried about. but it looks like they've been pretty steady through the history. So let's go into the finance. And like I said before, I like doing the finance on MSN because I can look at it and see what it does. So I like to look at how it's been doing from 2017 to 2024, see if it has a growth revenue. 93 billion, 117 billion, drop down, 113. Now it looks like it's been decreasing from 2022 to 2024 for revenue. Well, that's not good. That means I should expect the stock price to drop. Now, let's see what their gross margin is. This is important for me. How much profit are they making whenever they're purchasing, drilling, or doing whatever they're actually doing? It's 3.70%. I do not like this gross margin. This right here is just too little of a gross margin, and net profit is 2.31%. And that is too low for me personally. Especially if you're paying dividend, I would like to see the gross margin and net profit to be higher, because they could stop paying dividend, and then what's the point of having a stock in my dividend portfolio? Now, let's go into my income, the balance sheet, to see how they've been doing on their cash flow, equity, and everything else they've been going into. So the current asset is 23.74 billion. It dropped from 2023. Fixed asset is 36 billion, and current liability is 15 billion, and long-term debt is 7.59 billion. So what I like to do is to see if they're worth more with their assets versus their liability and long-term debt. And yeah, they're worth more. So 15 plus 7 is 22 billion in debt, and their current asset is 23 billion. So they're worth about 1.74 billion. So they're worth about, let's say, $37 billion roughly, with their fixed asset and current asset. So they are worth money. Now let's look at the cash flow. So I like to look at the free cash flow. How much cash flow do they have, and is it going up or going down? So in 2022, it had 10.89 billion, dropped to 8.32 billion, and now 2024, it is 5.78 billion. Yeah, I don't like that. That means that they are using more money than they're bringing in, according to this cash flow. And then ending cash position is an important one to look at, and that is just show the ending cash balance at the end of the period. And it went from 5.42 billion to 4.83 billion. Yeah, it's losing a little bit of money. So I don't know why. So let's check if the earnings, have they been doing better? So they've been forecasted, and they look like they hit all the target. That's a good part. So yes, they've been hitting all their revenue marks. So the performance for 5 days is 3.13. 1 month is 18.24. 6 months is 23, and 1 year is 16.83. Now, it is a buy for the investors. And I don't disagree on that buy for you to purchase this if you wanted to purchase this stock. But let's go in. It's just the best stock for you to buy. But before we go into all that, let's see what AI says about them. So the valuation 3 out of 6, and I agree with it. They're above the industry standard, and it's about 3 out of 6. Now the earning is where I have the issue at. So the earning is 1 out of 6, and I agree with it. The earning is not that great, but it looks like everyone else is in the negative too, but it's still not that great. I wouldn't recommend buying this because the future growth of Valero, yes, I think the future growth of the company is going to be good. off the forecast, and it's 3 out of 6. Now, historical performance is 1 out of 6, I agree. And financial health, it is 5 out of 6. Yes, financially, it's doing okay, but I think it's starting to lose money. They just have a lot of money, and I think they're gonna start struggling if they keep it at this rate. But they do make money, but their profit margin isn't that great, and that's probably one of the main reasons why I wouldn't purchase this. But talk about the stock. I just looked at it. Will I be buying this stock? No. I will not be adding Valero to my portfolio. It's not because the growth isn't there. The growth is there. You will probably get 12% to 20% every year if you're buying this stock. And it does pay a good dividend at a 2.88% year over year. Now, the finance says it's 5 out of 6. Well, one of the things I look at finance is their gross profit and their profit. I just cannot agree to purchase a company that has a gross margin of a 3.7 and a net profit of 2.31. When I compare it to the other ones in that industry, like Chevron or ExxonMobil or any other oil company. So that profit margin is too little for me to worry about because they could take away dividends. And if they take away dividends, then what? Then the stock's going to drop, and then I'm going to have issues with the stock. So I just can't do that. At the end of the day, you have to pick and choose your limits. Just like if we compare it to Marathon Petroleum Corporation, their gross margin is a 10.08 with their net profit of 3.61. So even though they're a smaller company, their margin is better. And that's what I am looking at there. And that's the only reason why I'm not buying it. I'm looking at the finance statement. Now, should you buy it? Well, it is a good growth stock and you do not have a energy company. I do recommend you to buy it. But I have a few energy companies in my portfolio that I think will do better than Chevron. So I went with that instead. Doesn't mean I won't come back and see what it does next year to see if I want to purchase it. Because I do have ExxonMobil already. So if I compare it to ExxonMobil, hey, maybe it'll do better or worse. But I don't want to add too many in this industry because I'll be too saturated. Now, if I compare it to ExxonMobil on their finance side, so ExxonMobil gross margin is 29.53% with a net profit of 10.33%. So in this situation, I'd rather buy ExxonMobil because their gross margin and net profit is better than Valero. And that's the reason why I'm not purchasing it, because if I do a comparison with ExxonMobil, it's the stock I do have in my portfolio, it just doesn't compare to it on that aspect. And there's no point of having too many in one industry because it could hurt my portfolio when oil or anything takes a tank. So like and subscribe to my video, and that's all I got for you.